Hey traders, Chris Dunn here, and in this video we're going to be looking at the basics of E-mini trading part 1. Alright, before we get started, let me just say that futures trading is risky and you really need to take the time to develop your skill and discipline as a trader before risking your cash in this market. Alright, so E-minis are futures, and for those of you who are unfamiliar with futures, let me just go over the basics. What is a futures contract? All right, and I want to look at a futures contract by comparing it to buying a home. All right, and step one, before you actually move into the house, you probably sign the contract, right? Meaning you determine the price of the home, the terms, the deposit. You figure out all the terms and you sign an agreement saying you're going to buy that home, right? And then in step two is when you actually close on the house, where you pay for the house either with a mortgage or cash, put your down payment down, take delivery, and actually move into the home, right? Well, the same thing works with futures, be it stock indices, corn, pig bellies, oil, or any other commodities, any other futures contract. You're basically agreeing to purchase something at a later date, but agreeing to the terms now. Okay, so unlike investing in stock, you're not actually investing in a company. You were just signing an agreement that you're either going to buy or sell a futures contract. All right. So what does E-mini mean? What is an E-mini? All right, this is a question I get a lot. E-minis are essentially futures contracts that are based on a stock indices like the S&P 500 or the NASDAQ or the Russell 2000 or the Dow. So the S&P 500, as you may already know, is a basket of 500 stocks, right? And essentially it's an index, and there's a standard S&P 500 futures contract that's traded in the pits at the Chicago Board of Trade. You guys may have seen or be familiar with the trading pits where you have a bunch of people doing the open outcry, buying and selling, screaming at each other, and all that craziness, right? Well, the E-mini is similar, but the standard futures contract of the S&P 500 is actually traded in the pit, and they trade for points. It's $250 a point, and I'll explain what that means in a minute. But the E-mini is a type or a derivative of the S&P 500 futures contract. The E means that it's traded electronically. There's no trading pit. And the mini means that it's 1/5 the size of the standard contract. Or instead of $250 a point, it's $50 a point. So how do we make money when we trade E-minis? All right. Again, we trade for points. All right. And we look to buy and sell E-mini futures contracts intraday for income. So, you can use E-minis and futures contracts in a couple different ways, and I won't get into that here, but you can do hedging. If you're hedging another position, you can buy and sell long term. What we typically do is look to buy and sell contracts intraday for income. So we're in and out in a relatively short amount of time. And like I mentioned earlier, we trade for points, where each dollar value change in the index is 1 point. So let's say that we buy the S&P E-mini at 1200 even, and then we sell the position when the market goes up to 1201. So we bought at 1200, sold at 1201, now we're flat. We just made 1 point, or $50 a contract, right? And what'll happen as you're trading intraday, let's say you take, 3, 5, 7 trades, whatever it is during the day, at the end of the day, usually around 11 o'clock at night or midnight, you'll get an email, usually from your broker, with an account statement either crediting your account for the money you made or debiting your account for the money that you lost. So it can really be like a daily paycheck. All right. And to take this a step further, within each point there are 4 ticks on the S&P. So from 1200, instead of going from 1200 straight to 1201, we go from 1200 to 1200 and a quarter, 1200 and a half, 1200.75, and then to 1201. So there's 4 ticks per point, and each tick is worth $12.50, which each point would then equal $50. Okay, so here's an example of trading for short-term profits. All right, this time frame, everything you see on this chart, is about 15 to 20 minutes worth of market action. Okay, and you can see we had 2 trades during this time frame. We had a short here at 1074.75, and then we covered it at 1071.50, which gave us a profit of 3 1/4 points. And here we had a long, meaning we bought first and then sold to make money when the market was going up. Bought at 1,074, sold at 1,077. So altogether, we made 3.25 points on this trade, 3 points on this trade, for a net profit of $312.50 per contract, all in about 15 to 20 minutes. All right. So let's talk about, why we want to trade E-minis. What is the benefit? Why would you want to trade this over stocks or Forex or options? Um, with E-minis, you have a lot of volatility and liquidity, which for day traders means opportunity, right? Obviously, the more movement you have and the more market participants that are participating in that market and the more money that's flowing in and out means more opportunity. For longer term day traders for longer term position traders or swing traders, volatility may or may not be a good thing. For day traders, it's definitely a good thing. All right, and the E-minis have a lot of it. There's also a lot of leverage, and just to show you how leverage works, with the E-mini S&P, you are essentially the amount of S&P that you control is $50, the point value, or the multiplier times the price of the index. So let's look at the example of, if we were at 1,200 on the S&P times 50, you're controlling about 60,000 worth of the S&P 500. Now, that does not mean that you have to have $60,000 or that you invest $60,000 cash. The way that futures contracts work is you put up what's called a performance bond or a margin, which is required by your broker, and it's a little bit different per broker. You can control one S&P contract with as little as $500 margin, or as high as $3,000 to $5,000 margin. Now, just kind of a side note, I do not recommend using $500 margins for the futures markets. If you are over leveraged, it can really be a double-edged sword. If you know what you're doing and you're properly capitalized, futures can serve you well. If you're over leveraged and undercapitalized and you have a little bit of a drawdown, it can really wipe you out. And I think that's one of the most common mistakes made by new traders is getting over leveraged. So, as long as you keep a nice margin, leverage will never be a problem. There's also no pattern day trading requirements, meaning that with stocks and some other markets, you need to have a minimum of 25,000 in your account to day trade equities, right? With the minis, the minimum is whatever the minimum brokerage requirement is from your broker. All right, there's also no short selling restrictions, meaning you can make money when the market goes down just as easy as when the market goes up. And with some equities and other markets, there have been bans and restrictions on that. Okay. Also, E-minis are very simple to trade. You don't have to do a lot of research and scanning through hundreds of stocks or doing a lot of market research and fundamental analysis. When we trade, we sit down, we look at our charts, and we start trading. It's very, very simple. All right, so let's look at some income potential with E-minis. All right, and just kind of a disclaimer here. Some traders do well and above this. Some traders don't come anywhere close to this. And if you want to become a professional trader, you really need to take the time to develop your skill and get a proper education. All right, so let's say that you average 3 points a day, all right, which would be $50 a point times 3 points a day would equal $150 per contract, right? Let's say you're trading with 10 contracts, which would be $150 times 10 contracts. That'd give you $1,500 a day. And let's say that you're trading 200 days out of the year. All right, there's actually closer to 250, but if you're like me, you probably want to take some days off and go away for a holiday, or just take some days where you don't trade. And so let's say conservatively you trade 200 days a year. That'd be 200 times 1,500, your daily income would give you a gross potential of around 300,000 a year. So there's definitely a nice six-figure income potential in this business. Now again, some people trade with a lot more than 10 contracts, some people trade with less than that. Let me give you an idea of my trading plan and how we approach the market. On average, I trade for about 90 minutes a day. All right, typically from market open around 9:30 to about 11 o'clock or 11:30. And typically I look for an average win. So every time I take a trade, I'm looking for a profit potential of around 3 points. Now, I don't win them all. I look to win anywhere from 60 to 70%. And I'll tell you, I actually control my losses to be a lot smaller than my winners. All right. And on average, we get 4 to 8 setups in the morning session alone.